On behalf of everyone at Granite Harbor Advisors, welcome to the very first 15-minute quarter. We created this because we wanted to not only provide our clients and their friends with some market commentary over the past 90 days, but we wanted to do so in a way that did not put people to sleep after the very first sentence. And for better or worse, my particular brand of sarcasm and self-deprecating humor does not translate well to the written word. So here we are. Our goal is to put these out every quarter and not only address what happened in the markets, but also talk about some of the events that occurred or address some common questions that we received. We're affectionately calling this one Small Cap Takes a Victory Lap for reasons that will become painfully obvious as we get deeper into the presentation. Now, because nobody's happy until the lawyers are happy, we have a few legal items to take care of before we get started, not the least of which is that this is really intended to be for informational purposes only and not investment advice. Also, the opinions and any poorly crafted jokes are mine and mine alone. So if they're terrible, you have to blame me and not get mad at Granite Harbor Advisors. And lastly, when you hear us talk about performance, what we're really talking about is index performance. And there are hundreds, if not thousands of those. So if our numbers are a little different than others you see, it's probably because there's a slight difference in the index or the way it was calculated. For those of you who don't know me, my name is Nick Brown, and I'm one of the partners here at Granite Harbor Advisors. I hold both the CFA and CFP designations, which really means I was good at taking tests at one point in my life, but it also represents Granite Harbor's desire to bring an investment analyst mindset to certain aspects of financial planning in order to benefit our clients. As noted in the title, we're trying to keep these presentations to 15 minutes because anyone who has listened or heard me talk about the markets for an hour will tell you 15 minutes is plenty of time. However, if at the end of this video you decide, wow, I would really like to hear Nick talk more about this, then feel free to reach out to our office. And if you think to yourself, listening to Nick was like watching paint dry, then fortunately I have two other partners, Brian Sack and Tim Smith, who are equally willing and able to answer any questions that may come out of this. All kidding aside though, our main goal is to provide some context around what happened in the markets and provide people with what we think is important information so they can make informed decisions. So without further ado, let's get on with it. The first point we want to make is what a difference a year makes. If you think back to this time last year, most of us were concerned with finding homemade recipes for hand sanitizer and making our own toilet paper. The COVID-19 pandemic was the dominating force driving the markets through one of the swiftest and steepest declines in history. And do not get us wrong. There were and still are significant challenges that the pandemic has presented. Businesses were forced to shut down or close, millions of people lost their jobs, and hundreds and thousands of people in the United States subsequently lost their lives. But at the same time, we've also heard countless stories of resiliency, including in the markets. Since the pandemic first started, the equity markets have marched upwards from those March 2020 lows and are now resting at all-time highs. This is after almost a fourth of the economy went completely idle, and an entire decade of job growth was wiped completely off the books in less than 2 months. So if you're like most people, your March account statement is resting somewhere in a pile between a Pottery Barn catalog and a mailer for 10% off your next AC service. But when you get around to opening it, most people will see a balance that is higher than what it was back in January. And that's a good thing. That's what we're here for. What drove the positive performance was the fact that equity markets were largely positive during the first quarter, continuing that trend that we saw starting back in March of 2020. In the United States, the broad market was up 6.35% versus 4.04% for developed international stocks and 2.29% for emerging markets. Also notable was the fact that global real estate was positive to the tune of 6.22% following a negative 9% year in 2020. But what's good for bonds, or what's good for equities, is not always good for bonds. So while we had strong equity returns over the last quarter, the US bond market quietly had one of the worst quarters on record. And that's a function of investors demanding increased yield in their bond investments, especially if inflation concerns continue to rise. Since most bonds make a fixed interest payment, the only way to get that increased yield is if bond prices go down. And that's what we saw in the first quarter, largely for bonds that won't come due for another 20 or 30 years. Bonds that are not due for a long time are much more sensitive to changes in interest rates, both up and down. So while those long-term bonds did very, very well in 2020, they've performed rather poorly in 2021. Fortunately, for those investors who owned bonds that are coming due a little sooner, the impact was not quite as significant. So if you're looking at these numbers, you may be thinking to yourself, I wish I owned nothing but stock. And if you had a crystal ball at the beginning of the quarter, you would be 100% accurate. Quick side note, if anyone does have that crystal ball, you should definitely reach out to our office because I am certain we can work out some sort of rental agreement. But absent this magical future predicting device, what these numbers really illustrate is the risk return relationship and why it's important to own different things for different reasons. While not always the case, stocks tend to perform opposite of bonds. When stocks are up, bonds go down, and vice versa. By owning both, we give ourselves a chance at a more consistent long-term return. We also own bonds, stocks and bonds together because they're structurally different. While stocks have the ability to go up 22% in a quarter, as last year showed, they also have the capability to go down 20+% in a quarter. And that's a ride most people do not want to take. Meanwhile, we tend to get more muted performance, both up and down from bonds, which means you can have a hot cup of coffee with no lid in your lap while you're taking that ride. The end result is most investors should have a mix between stocks and bonds that is appropriate for their set of circumstances. The equity numbers we discussed were buoyed by good news that continues to come out of the job market, vaccine rollouts, and states reopening. There is, it would seem, some light at the end of the tunnel as we cautiously get back to normal. Looking back on the quarter, there were a lot of unique headlines that popped up. Bitcoin continues to be the internet's version of a magic bean, hitting $50,000 for the first time in history and gaining traction with retail and institutional investors alike. The internet also flexed its muscle with GameStop and helped drive, which was essentially the blockbuster video of video games, to some pretty eye-popping performance numbers last quarter. But beyond that, we also saw a fresh round of government stimulus, and this has led to many questions about inflation and the impacts it may have on a portfolio. This is a topic we will talk a little bit more about in just a moment. But in addition to the stimulus, we also saw the market hang on and in fact set new all-time highs, continuing a trend that started late last year and all the way through this first quarter. Most notable amongst those high was the performance of small caps and value stocks. So while the market clipped along at a nice 6.35% pace, small value stocks performed over 3 times better than that at 21.17 as measured by the Russell 2000 Value Index. After being pummeled from the outset of the pandemic, small caps are finally getting to take that victory lap that a lot of investors have been looking for. Another example of the, hey, where's that crystal ball effect, was in the commodities market. We mentioned a few minutes ago that stimulus packages have kind of created this inflation concern because of the pandemic. Investors are becoming concerned with the amount of money that has been placed into our economic system. At the same time, supply is constrained by shutdowns. As a result, we've been fielding a lot of questions on the merits of commodities, and specifically gold and silver as potential investment opportunities. And make no mistake, precious metals and other commodities can play an important role in a well-diversified portfolio. However, after people started becoming concerned about inflation, those two asset classes went on to be two of the worst performing asset classes this first quarter, after gold had banner years in 2019 and 2020. Again, that is not to say neither of them cannot play a significant role as part of a portfolio, but rather to highlight the impossibility of trying to predict where prices will go in the short term. Rather than trying to guess at what may or may not happen in the future, we want to try and lean on diversification to help address some of these unforeseen challenges. Hopefully, everyone is still with me, but if you've started checking your LinkedIn feed or Instagram, now's the time to perk up, because this is where the rubber meets the road. These numbers represent purely hypothetical portfolios that show a mix between global stocks and treasury bills. This page is what should help provide some context when you finally get around opening up that March statement. As we would expect in an increasing stock market, those portfolios that owned 100% stocks did the best this past quarter. They've also done the best over the last 1 year, 3 years, 5 years, 10 years. But as we said earlier, it was a heck of a bumpy road to get there. And most investors probably needed access to their funds at some point along the way. And that's where these other portfolios come in handy. So when you're looking at your March statement, it would be helpful to know what type of portfolio you have. For instance, if the term moderate rings a bell, then you're probably somewhere between a 50-50 portfolio and a 75-25 portfolio. All that means in a 50-50 portfolio, it's 50% stocks, 50% treasury bills, or 75% stocks and 25% treasury bills. That means you can use this 2.3% to 3.5% as a general guide of what to expect. And those numbers are just that. They're a guide, something to measure against and provide some context. Being above or below those thresholds is not inherently a bad thing, as long as the reason behind it is valid. For instance, portfolios that have a higher proportion of smaller value stocks were to perform much better over this past quarter than the guidelines would indicate. At the end of the day, a successful portfolio is one that efficiently captures performance, meets your financial needs, and doesn't keep you up at night playing mental chess on the ceiling of your bedroom. Hopefully this has been time well spent, but as I mentioned at the beginning, if you have more questions at the end of this video than when you started, please do not hesitate to reach out to our office. Our #1 goal is to help people as much as we can understand the pros and cons of all the different financial decisions they have to make. So feel free to reach out to us either by phone at 832-461-0789, email info@graniteharbor.com, or at our website, graniteharbor.com. And we'd be more than happy to help any way we can. Thank you very much and have a great day.